Are you tired of watching your hard-earned money slip away in every trade you take? In this video, I'm going to share 10 common mistakes that beginners often make when trading. And by learning what to avoid right from the start, you can set yourself up for success and build your confidence when trading stocks. First up is not practicing trading first. Now, jumping straight into a live trading account without using a demo account first is high risk. It's always best to use a practice account first. Not only to test your own rules and strategies, but also to get used to placing orders on the broker platform. A demo account will allow you to simulate real trading without risking actual real money, providing a safe environment to learn and practice. You can try out different trading strategies by backtesting your rules to see what works and what doesn't. Don't forget, most demo accounts use real market data and allow you to test all the real features and tools of a live account, so there really is no downside. A demo account also helps you to understand how global news events impact the markets and help you develop the discipline needed for successful trading. Number 9 is focusing on profit. New traders often focus on how much profit they can make on each trade. Now, whilst it's important to have a profit target in mind, risk management should be your number one focus. The truth is, as a trader, you're going to lose lots of trades, with many traders having a long-term win rate of around 50%. Now, if you're a rookie trader watching this, 50% may sound low, but with excellent risk management, it is adequate to be profitable long-term. The key is when you're in a losing position to cut your losses quickly, and when you're in a winning position, you must let your profits run. Rather than dreaming about how much profit you can make from a trade, your focus should be on how much you lose if you're wrong. Now, before you enter a trade, you need to calculate the maximum amount of cash you can lose, ensuring you do not exceed 2% of your total capital. Number 8 is being too focused on the trade outcome. The best traders focus on the process of trading, sticking to their plan and executing their rules to the letter. Beginners often focus on the outcome of the trade, winning or losing. It's important to remember the stock market is inherently unpredictable, and outcomes can be influenced by numerous factors beyond your control. When you focus on the outcome of a trade, it can lead to emotional highs and lows, which can cloud judgment and lead to impulsive decisions. However, by prioritizing the process of trading, you can maintain a more stable emotional state, reducing the impact of fear and greed. Now, this emotional resilience is essential for making rational decisions, especially during volatile market conditions. Mistake 7 is switching strategies too soon. A good strategy should be simple to follow and outline specific criteria for entering and exiting trades. This will help you stay objective and unemotional. One of the most common mistakes you can make is switching strategies when you take a few losses. Don't forget, you must backtest your strategy to prove it works and how often it works on the specific stock you're about to trade. For example, if you're using a break and retest strategy that works 60% of the time, you should obviously expect to lose 40% of the time. The key thing to remember is that you cannot predict the sequence of events. You may lose the first 4 trades using the tested strategy and give up, only for the next 6 trades to be winners. At number 6 is trading too big. Whilst it's tempting to go big on A+ setups, you must remain disciplined on each and every trade. Your position size should be based on a percentage of your total capital, with 10% being a good starting point for buy and switch type portfolios. For a buy and sell trading portfolio, you may wish to go up to a 20% size, bearing in mind you must not violate your risk management rules in the process. As an example, if you wanted to take a short-term trade on Nvidia, taking a 20% position based on an $80,000 account, this would equate to a 16 grand position. Using the 2% rule, The maximum you can risk on the trade is $1,600. Therefore, the stop loss you select, whether it's a fixed percentage or a recent price low or trough, the total exit amount cannot exceed $1,600. If it does, you've got two choices. You either have to lower your stop loss or reduce your position size. Now, usually lowering your position size is the better option, as if you make the stop loss too tight, you risk being stopped out before the trade unfolds. Chasing losses is at number 5. Chasing losses is a common mistake in trading, and it can be particularly dangerous for several reasons. When traders chase losses, they often act out of emotion rather than logic. This can lead to impulsive decisions that have zero rules and zero strategy. Losing is part of trading. It's impossible to win every trade, even with a great back-tested strategy. The worst thing you can do is take another position immediately after a losing trade, trying to win back money you've just lost. You must accept sometimes your rules just won't work because of unpredicted market volatility. The best thing you can do is walk away from your desk, take a walk, clear your head before reviewing the trade the next day when you're calm and rational. The stress and frustration of chasing losses will affect your mental state, leading to possible burnout or lack of confidence in your trading abilities. So, whatever you do, never chase losses. Just accept that it's normal to lose and learn what you can from the experience. At number 4 is rules. As a beginner trader, you may have an overall strategy, but without black and white rules. This can lead to inconsistent results. Building a set of rules will allow you to create a trading blueprint that you can use repeatedly when the same market conditions occur. Now, these rules need to be as simple as possible, but extremely precise, so that if you wrote them down and gave them to another trader, they could execute your strategy exactly the same as you. For example, Charles Dow developed Dow Trend Theory, which is based on peaks and troughs. A general rule would be that you would buy a stock once you have a higher trough followed by a higher peak. However, a more precise rule would be that you'd buy a stock once price trades 1 cent above the last peak, following a higher trough. The second rule is more precise, and it gives you the exact price level you would buy the stock. Following objective rules will get you in and out of the trade at the right time, minimizing risk and maximizing profits. Now, before we get into the top 3, if you're finding value in this video, you may want to grab a free written copy of these common mistakes. I'll leave a link in the description below. Click on the link and grab a free copy from my website. Now for the top 3. At number 3 is patience. When I first started trading, I was guilty of overtrading. I always wanted to be in a trade with a chance of making money. Recently, however, I'm now far more selective with the trades I take. Successful traders wait for the right opportunities instead of jumping in impulsively. Patience allows you to wait for the best setup when price, pattern, and time all align to offer the highest probability trades. For example, if you're eyeing a stock that you believe has strong potential but is currently overvalued, it's essential to wait for the price to drop to a more attractive level before making your move. This might mean waiting weeks or even months, but selecting only the best setups will significantly increase your win rate and profitability. Don't chase the market, stalk the market and let it come to you. Patience also applies after entering a trade. It's crucial to give your positions time to develop according to your plan, rather than constantly checking your portfolio and reacting to short-term fluctuations. Number 2 is not having a plan. Creating a written trading plan is essential for anyone trading in the stock market, and it offers various benefits. A well-structured trading plan promotes consistency in your trading approach. By outlining your strategies written down, entry and exit criteria, and risk management rules, You can avoid impulsive decisions and stick to a systematic approach. Trading can be emotionally charged, leading to fear and greed influencing decisions. A trading plan serves as a reference point, helping you stay disciplined and allowing you to make rational decisions based on your predefined criteria rather than your emotions. A good trading plan also allows you to track your performance over time. And by reviewing your trades against your plan, you can figure out what works and what doesn't, enabling you to refine your strategies and improve your overall profitability. And the number one mistake I see new traders make is not using a stop loss, which is essential for sound risk management. Trading without a stop loss is like driving a car without a seatbelt, extremely high risk. Many journeys will be uneventful, but that one journey when you have an accident, that can be catastrophic. Putting on a seatbelt takes just seconds and will protect you in the event of a crash. And so with trading, it takes just seconds to place a stop loss order, protecting your capital if the trade goes against you. Using a stop loss is the most important part of risk management. Your stop loss order will take you out of a losing trade quickly and protect your capital in the process. And you should always calculate your stop loss before you enter a trade, with the total amount not exceeding 2% of your total trading capital. For example, if your total capital was $50,000, the maximum amount you can lose on any single trade is capped at $1,000. If you found this video helpful, hit that subscribe button to support the channel. And if you want these top 10 mistakes in a PDF guide, you can download it for free via my website. Link in the description. Thanks for watching.